Hey, it's Finn, and before we get into anything today, I want to tell you about a moment that changed how I think about money forever. A few years back, I was at the airport, flight to Miami. I walked up to the check-in counter, handed over my credit card, and the agent smiled and said, "You've got enough points for a complimentary upgrade to business class." Just like that, lie flat seat, free champagne, the works. I remember leaning back in that wide leather chair at 30,000 feet thinking, I have figured this out. The bank is literally paying me to fly in luxury. I am winning. And here's the part nobody told me. I wasn't winning. Not even close. By the time that flight landed, I had racked up more credit card debt in the previous 12 months than I'd spent on groceries, utilities, and gas combined. I had chased reward points like a second job. I'd signed up for 3 different cards. I'd paid 2 annual fees, and I had carried a balance every single month, quietly bleeding interest at 24% while feeling like a financial genius in business class. That's the thing about credit cards. They are the single most sophisticated psychological trap that the financial industry has ever built, and they're designed to feel like a gift while they're picking your pocket. Today, we're going to pull the curtain back on all of it, how credit cards actually work, why the interest-free period is one of the biggest illusions in personal finance, why the rewards are engineered to make you spend more, not save more, how your credit score quietly holds your life hostage, and finally, the right way to use a credit card, if you decide to use one at all. Let's get into it. Okay, let's start at the foundation, because I've talked to a surprising number of people who use credit cards every single day without fully understanding what's actually happening when they swipe. Here's the simplest way I can explain it. When you use a debit card, you're spending your own money. Your bank account goes down in real time. You buy a $60 dinner, $60 leaves your account tonight. Done. It's direct, immediate, and honest. A credit card is something different. When you swipe a credit card, you're not spending your money, you're spending the bank's money, with a promise to pay it back later. That dinner, the bank covers it. Your account stays untouched. But now you owe the bank $60. That's it. That's a credit card. It is a short-term loan issued instantly with no paperwork and no approval process in the moment because you already went through all of that when you applied for the card. Now, every credit card comes with what's called a credit limit. Think of it like the bank saying, "We trust you up to this amount." Some people get a $500 limit when they first start out. Others get $5,000, $15,000 or more. That limit is based on your income, your credit history, and how the bank assesses your risk as a borrower. The more responsible you are with the card over time, the more the bank tends to increase that limit, which, as we'll get into, isn't always a good thing. Here's what makes credit cards psychologically unique. The friction is gone. When you pay with cash, you physically hand something over. You feel it leave. When you use a debit card, you at least know your balance is dropping. But a credit card? You swipe, tap, or click, and nothing immediately changes. Your bank balance is the same, your wallet feels the same, the bill doesn't show up for another few weeks. It's the financial equivalent of eating a meal and not feeling full until tomorrow, and by then, you've already ordered dessert. That frictionlessness is not an accident, it is by design. Alright, so now you understand the basic mechanics, and I can already hear some of you saying, "Finn, I get it, it's a loan, but I pay my balance in full every month, so I never pay interest. I'm using the bank's money for free, how is that a trap?" That's a fair question, and it's the exact question I used to ask myself, so let's answer it honestly. Here's how the billing cycle works. Every month, your credit card company sends you a statement. On that statement, you'll see 2 numbers. The first is your full balance, the total amount you owe. The second is your minimum payment, the smallest amount you're required to pay to avoid a late fee. Sometimes that minimum is as low as $25 or $35, even if you owe $1,200. Now, the card company doesn't require you to pay the full balance. They actually prefer you don't. Here's why. If you carry even a single dollar of balance from one month to the next, the grace period disappears on that balance and interest starts accruing. And we're not talking about a little interest. As of 2025, the average credit card interest rate in the United States is sitting above 20%. Some cards go as high as 29.99%. That is not a rounding error. That is roughly 6 times the long-term average return of the stock market applied against you. Let me put some real numbers on this. Say you have $3,000 in credit card debt at 22% interest. If you only make the minimum payment each month, let's call it $75, it will take you over 5 years to pay that off. And by the time you're done, you'll have paid nearly $2,000 in interest alone on $3,000 of purchases. That's what happens when you only pay the minimum. And this is not a rare situation. Americans are collectively carrying over $1.2 trillion in credit card debt right now. That's trillion with a T. The banks are collecting interest on that balance every single month, and it is one of the most profitable revenue streams in the entire financial industry. industry. But here's the thing that really gets me. Even people who believe they pay their balance in full every month often don't. Why? Because the minimum payment looks so reasonable on the statement. $1,500 balance, $35 minimum due. If you're busy, if you're stressed, if you just glance at the bill, you might pay the minimum and move on, not fully registering that $1,465 just rolled over into next month with interest attached. That's not stupidity, that's behavioral design. The statement is laid out to make the minimum payment feel like the normal option. And even if you do pay in full every single month without fail, there's still a cost, because most premium credit cards charge an annual fee, sometimes $95, sometimes $250, sometimes $550 or more for the high-tier cards. Whether you use the card heavily or barely at all, that fee gets charged every year without exception. The more rewards and perks the card offers, the higher the annual fee tends to be. You're essentially paying for access to the rewards program, which brings us to part 3. This is the part that surprised me the most when I really dug into it, because I genuinely believed for a long time that rewards programs were the one part of the credit card equation where the consumer comes out ahead. I was wrong. Let's start with the basic math. Most consumer credit cards offer somewhere between 1% and 2% cash back, or an equivalent in points. If you spend $1,000 and earn 2% back, that's $20. If your card gives you 1.5 points per dollar instead, you've got 1,500 points. Sounds reasonable. Now, what does 1,500 points actually get you? Not much. A domestic round-trip flight on most major airlines reward programs costs somewhere between 15,000 and 25,000 points. An international trip often requires 60,000, 70,000 or more. At 1.5 points per dollar spent, you'd need to put over $40,000 on your card just to get a single international flight with points alone. That is not a perk, that is a hamster wheel. But the real issue isn't the math. The real issue is what the rewards program does to your behavior. Study after study in behavioral economics has found that people consistently spend more when they pay with credit cards than when they pay with cash or debit. The psychological distance of delayed payment makes the spending feel less real. And when you're chasing points on top of that, every purchase becomes rationalized as progress toward a goal. I'm not spending $80 on dinner, I'm earning points. I shouldn't buy this new laptop out of my savings. If I put it on the card, I get 3 times points. The banks know this. They built the rewards program specifically to exploit this tendency. The more you spend, the more points you earn, and the more you feel like you're winning, while the bank is quietly collecting swipe fees from every merchant you buy from, plus interest from anyone who carries a balance, plus annual fees from everyone else. And there's one more layer to this that most people never think about. Every time you swipe your credit card at a store, the merchant pays a processing fee, typically between 1.5% and 3.5% of the transaction. That fee goes to the card network and the issuing bank. And where do merchants get that money? They bake it into the price of everything they sell. So if you're paying cash at a store, you're partially subsidizing the rewards program for everyone paying with a premium card. The system extracts value from everyone and funnels it toward the cardholders who spend the most, which are, more often than not, the people who can already afford to spend a lot. Let's talk about your credit score, because this is where the whole credit card ecosystem starts to feel less like a product and more like a system. Your credit score is a 3-digit number, typically ranging from 300 to 850, that represents how trustworthy you are as a borrower. It's calculated based on things like whether you pay your bills on time, how much of your available credit you're using, how long you've had your accounts open, and whether you've recently applied for new credit. A high score, generally anything above 740, opens doors. Lower interest rates on mortgages, better terms on car loans, easier apartment approvals. In some states and industries, even better insurance rates. Some employers check credit scores as part of background screenings for financial roles. A low score closes those same doors. It can cost you tens of thousands of dollars over a lifetime in higher interest payments alone. It can get your rental application rejected. It can make an already stressful financial situation dramatically worse. So here's the trap that credit cards set within this system. The single most common advice for building a credit score is to get a credit card, use it regularly, and pay it off on time. And that advice isn't wrong. Payment history and credit utilization are the 2 biggest factors in your score. Responsible credit card use genuinely does build credit, but here's what happens in practice. People hear, use your card to build credit, and they internalize it as more spending equals a better score. That is not how it works. But the psychological pull toward more usage is strong, especially when the rewards program is simultaneously encouraging you to put everything on the card. So people start charging things they would have paid cash for, carrying balances they didn't intend to carry, and chasing a number that feels like a measure of financial health, when really it's a measure of how much you've borrowed borrowed and how reliably you've paid it back. The credit score is a real thing with real consequences, and I'm not here to tell you to ignore it, but it's worth recognizing that the entire apparatus, the card, the rewards, the score, is engineered to keep you engaged with borrowing. Not because borrowing is inherently good for you, because it is good for the institution that lends to you. Here's where I land on all of this after going through my own learning curve with business class flights and 5-figure interest charges. Credit cards are not inherently evil. They are tools, and like any tool, they can help you or hurt you depending on how you use them. The people who genuinely come out ahead with credit cards are the ones who treat them like debit cards with a 30-day lag. They only charge what they already have the cash to cover. They pay the full balance, not the minimum, not most of it, every single month before the due date, no exceptions. The moment you carry a balance at 20% plus interest, every reward you've earned is effectively wiped out and then some. If you're just starting out and building credit, you don't need a premium card with a $500 annual fee and complicated reward tiers. A no annual fee card used lightly and paid off every month will build your credit score just as effectively with zero risk of paying the bank for the privilege. If you do want to use rewards, be honest with yourself about whether the math actually works in your favor. Add up what you spend annually on the card, calculate your actual cashback earnings, subtract the annual fee, and see whether you're genuinely ahead. Most people, when they run that honest calculation, find the margin is much smaller than they imagined, and it's often negative once you factor in any months where they didn't pay the full balance. The golden rule is simple. If you can't pay for something with cash you already have, a credit card should not be the answer. So, where does all of this leave us? Credit cards are one of the most cleverly designed financial products in history. They feel like a favor, like the bank is extending you a hand, rewarding your loyalty, giving you free vacations and cash back out of the goodness of their hearts. And that feeling is engineered. The interest-free window exists to get you into the habit of using the card. The rewards exist to make you spend more. The minimum payment option exists to keep you carrying a balance. The credit score system makes you feel like you need to keep borrowing to stay financially healthy. Every piece of it is interlocking. Every piece of it generates revenue for the bank. That doesn't mean you can't use a credit card responsibly. It means you have to go in with your eyes fully open, understanding that the house always has the structural advantage, and the only way to win is to never give the house what it's designed to collect. Pay in full, every month, without fail. Stay within your means. And if you ever find yourself in business class wondering how you got there, maybe double check the credit card statement before you order the champagne. I'll see you in the next one.